Hello, everybody. Welcome to Tuesday's Top Tips. I'm so glad that you're here today. And I want to challenge you on something that has shaped our industry for over a decade. And that is the biggest lie in our industry, that people want credit repair. All right, before you guys get all upset and tissy about it, let's be honest. People don't want credit repair. People want to be able to get things for their future. Buy a house, buy a car, good interest rates, financial freedom. That's what they want. They don't want credit repair. So maybe, just maybe, we've been working in our industry the wrong way all along. And that's what I want to present to you guys today. Again, people don't need credit repair. They need borrower readiness. So that's what I'm going to be talking about today. Now, just to kind of put this in perspective, I want you to think about this for a second, okay? When I say the words, people don't need credit repair, does it instantly go to you thinking, well, yeah, they do. That's why they buy credit repair? Or do you instantly go to, well, people are always asking me, can I get their score up to a 750? Because if that's what you're thinking in your head, then I think maybe we're thinking two different things, okay? People oftentimes will go to a solution that they think is the solution to their problem. And that's why this industry, unfortunately, has been known as a scam. Or as, you know, we're saying we're going to give somebody something and we don't actually give it to them. So let me go back to that for a second. So let's think about this for a second. If I'm a credit repair organization, like most of us are credit repair organizations, if that's what I am, and a client comes to me and they say, hey, you know what, I really need to fix my credit. I want to buy a house. And we say, great, we can help you. And then we focus on the credit report and getting their score up to a 750 score. And then they march on their way thinking they've got what they needed, and they go to the loan officer and get denied. Did we provide them what we said we were going to provide them with? Okay. Obviously, that's a clear answer. The answer is no. Okay. And maybe it's not our fault. Maybe it's not that we're trying to deceive them, but we think, because the industry has taught us, that removing things off of a credit report, improving a credit score, equates to qualification. Or being ready, a borrower readiness, for instance, okay? All right, so different scenario. Client comes to you, they ask you for a 750 score. And you say, yes, I'd love to help you get a 750 score. And then you help them get the 750 score. And at the end of that, when they still can't qualify for things, they're mad at you, even though they asked you for a 750 score and you gave it to them. What do you think about that? And if we really dive into that, we never really ask them why they wanted a 750 score. No one actually wants a 750 score. No one does. And here's how I can prove it to you. As a loan officer, back in the day, you could have a 600 score and I would be jumping up and down in my office because I would get you approved for a loan. I don't really even care what was on the credit report. It was the 600 credit score that got me helped me get you qualified for the loan. There's a couple other things that we had to look at. The 600 was like, I can do this. Okay. So back then, that kind of created this industry idea that credit score equaled approval. Okay. Things have changed, guys. We're not 20 years ago. It doesn't work like that. You can't have a 750 score and automatically get approved, right? Things are very different. The fall of 2008 created a shift in the credit industry that we did not prepare for. Maybe we didn't even know the shift happened. Many of us didn't, because the conversations never changed. The conversations never changed from credit repair to borrower readiness, even though the industry changed. The lending industry changed from credit score to full holistic borrower readiness. We didn't get that message, guys. We didn't get that message. Now, with the credit shift happening, right, that I've been talking about with the new credit scores, Vantage 4.0, FICO 10T, now we're starting to think, oh, there's a shift in our industry. But guys, that shift happened 2008. And we're just now getting the message. And so I hope this message for Tuesday's Top Tip resonates with you, because I want to show you what clients really want from you and how you can do that. Let's dive in. All right, the biggest lie in the credit industry is that people want credit repair. They don't. Again, like my scenario earlier, when I could get you approved at 600, regardless of what was on your credit report, what did you go and do? You went and bought your home at 600. So that proves to me already that they don't care about credit repair. I remember when I got into this industry and started helping people with credit, I remember sitting at my desk. I always seems to be the person that goes into a market in what I call a blue ocean, where I'm bringing something to light that wasn't really needed yet, or people didn't think they needed. And so when I got into the credit repair space, which I didn't even call credit repair back then because I didn't even know anyone else did it, I came in helping people with their credit. And it was during the time when, again, people could get a loan at 600 credit score easily, and they didn't really need to improve their credit. So guess what they didn't do? Improve their credit. The only time anyone would ever come to me to improve their credit is if they couldn't qualify. So I want you to think about that for a second. Nobody really cares about the 750 score. They care about what that score may or may not get them. And since we had that credit shift in 2008, guys, 2008, think about that for a second, because we're in 2026. The shift actually happened in 2008 with the fall of the mortgage industry when things changed. Score got you in the door, but we looked at so much more after that. And that's where we're at. We've been there since 2008. The message just didn't get to us. Now it's here. I hope you're listening. I hope you're listening and you're taking notes. I'm going to give you some pointers today. And I'm going to invite you to another class so we can deep dive into this some more. I'm also going to invite you to get certified as a borrower readiness professional. So stay with me because I'm going to give this information to you at the end. But I'm giving you a bunch of pointers right now. So again, the biggest lie in our industry is that people want credit repair. They absolutely do not want credit repair. They want borrower readiness. They want what that can give them for their future, okay? Whether that's buy a home, buy a car. So again, welcome to Tuesday's Top Tips. I'm excited to give this information to you. All right, so we've been solving the wrong problem. Let's think about that for a second. This is where I think our industry has gotten it wrong. This is why our industry looks like a scam. This is why you get complaints, okay? This is why, because we're solving the wrong problem. A higher score doesn't automatically create a qualified buyer. I'm going to show you some examples of that. I can give you many stories of people who had high credit scores but couldn't get the thing that they actually wanted with those credit scores. So for years, though, here in our industry, we've been marketing raise your score. I see it all the time. Got this, someone's credit score is improved by 100 points. Oh, wow. Seriously, oh, well, right? I know that. I know 100 points doesn't necessarily mean anything, right? And I'm going to show you some examples of that. So raise your score was a message. Oh, my favorite message that everybody talks about, remove negative accounts. I'm going to show you a client today that has negative accounts, and I'm going to show you a client who doesn't, okay? We'll talk about those too. Increase your points as a message, okay? For why? Why? What is increasing my points going to do for me? Now, we all know, I'm playing devil's advocate here, increasing credit scores is important. I know that if I have a higher credit score today, I get lower insurance costs, right? I know that having a higher credit score provides me with better interest rates. So higher credit scores do open doors for me that would not possibly be open, or savings that wouldn't possibly be open to me without the higher credit score, right? I do know that. So don't misunderstand what I'm saying. What I'm saying is that is not the only part of the puzzle, right? That's what I'm trying to say. But we advertise this. But not only do we advertise increase your points, raise your credit score, right? We advertise it, but we're also that's all we're doing. That's all we're doing. We don't understand what qualifies someone in the lending world. Well, why would anyone want a better credit score? Why would they want their credit improved? For lending opportunities. So why don't we understand that part of it, right? And so that's what I want to dive into. Maybe they want to get better numbers. The bigger question is, what happens after scores are improved? Can they qualify? Do they have the necessary financial backing to qualify? The financial health markers, if you will, right? Can they actually buy what they want? Can they actually qualify for what they want? There are other questions that need to be answered. Because if they can't, then we solved part of the problem. Part of the problem, but not the whole problem. Stated another way, a lot of credit repair professionals, I love this. They say stuff like, they're dispute mills. They're going to dispute, and get all this negative stuff off the credit report. And then in reality, it doesn't necessarily improve the credit score. Or maybe it does, maybe it doesn't. but doesn't improve the lendability of that person oftentimes. But that's what we're advertising, right? So again, disputes are a tool, just as scores are a tool. So we think of like scores being a tool for lending, disputes being a tool for scores. Does that make sense? They're kind of going down. So disputes are like kind of last in line from the score even, right? But then the score is after the lending ability, right? So that's just a tool for lendability. It opens the door, right? It helps get better interest rates. It helps have opportunities for savings. But again, it opens the door. What else needs to happen in order for you to get the key? And that's the message today. So a higher score does not automatically create a qualified borrower. The goal isn't score improvement. The goal is life improvement. That's why I remember when life coaches came about, it was like really exciting for me because I thought that's it. Life coaches. And that's not the answer, but that was more in line with what I was thinking in terms of what we're supposed to do as a credit professional, right? Is we're helping people improve their future, but it's not going to come through just improving their credit score or just getting negative items removed from their credit report. It's from us becoming borrower readiness partners. That's where it comes from. That's the missing piece. That's the gap we've been missing. That's the conversations we haven't been having, right? And it's also the reason I built Level Up Score, because now we have a software that actually does that for you. So those of you, if you're on this call and you have not seen Level Up Score, it's the answer to this. It's the answer to the gap that we haven't even been talking about because a lot of us didn't even know it was a gap, right? The gap happened in 2008, guys. It's 2026. We better get with the times. And not only is it 2026 and the gap happened in 2008, but now think about it. Things are changing even more drastic. You know, I had a fun conversation. If you guys saw on social media, I showed a Jamaican credit report. Now, the Jamaican credit reports are new in comparison to American credit reports, but they are more aligned to what a lender actually wants to see. They're more aligned to showing a lender whether or not this person can be qualified. And it has some really important information in it that we as borrower readiness partners should make sure that we are looking at, even though it's not on the American credit report. And so I think if we were to take note and kind of look at what other countries are doing that are newer to the credit bureau business and looking at, how do we actually assess the risk level of someone, whether they're going to be able to afford this property if they're buying a home or what, right? The lending, what does that look like? And so it's really, really interesting to see other countries' credit reports because they are more trended towards this whole idea of, can the person actually qualify, right? Can they pay this? That's credit worthiness, right? Where are they on that scale? And so the new credit reports, the Vantage 4.0 and the FICO, both of those are more holistic, looking at that trended data so that it would come up with a better risk level. And if we continue to trend this way, I don't foresee that we don't end up getting this space where, Jamaica, who's showing this really works, that we won't start adopting some of those things. So be on the lookout for that. But this is where we start today as the Borrower Readiness Partner. How do we help people today, right now? All right, so let me move on from this screen. Love this one. I'm going to expand this, so take my face off this. So the 750 versus the 660 example. I want to show this to you because this is actually two real clients that I've had in the past. We got client A with a 750 credit score. He's debt-free, no negative history. He does have minimal savings. I'll tell you why here in a second. Thin credit file, new credit file, no plan. Okay. Now, client A, just to give you a little heads up, he went through a Dave Ramsey program, and I'm not knocking Dave Ramsey, but what I am going to knock is that Dave Ramsey talks to the masses about, not having credit, open credit accounts, not paying on credit and paying everything cash. And that sounds magical for those who have money, but that's not the majority of people. And so if that's not the majority of people, we need to make sure the message goes to everybody. And so client A went through the Dave Ramsey program and then tried to qualify for a home loan and was denied. We'll talk a little bit more about client A. Client B, though, 660 credit score, stable income, has some money saved, has low debt burden, does have past negative accounts, still reporting on their credit report, but they're following a strategic action plan. Okay. He was able to get approved. There was one tweak that I did with this client that got them approved to get them to that 660 and let them go get their home loan. Okay. One tweak, and it had nothing to do with negative accounts. There was no disputes ever done for this client. Okay. On the other hand, client A here, he went through the Dave Ramsey program, actually a much harder situation. He went through Dave Ramsey. He paid off all his debt. Congratulations. He is debt-free, which is an amazing and wonderful place to be. But because of being debt-free, he doesn't have any savings. He took all of his money that he possibly had to put towards this debt to become debt-free. He liked the idea. He liked the ring of the tone of debt-free. I do too. It's beautiful. But in doing so, he also closed all of his credit files. This is where he made the biggest mistake. Okay. Closing all his credit files then created essentially no active credit. Okay. So then once you close out your accounts, those do not help you. So we don't look at past closed history and say, oh, this person had a great past, we're going to lend him money. No, that's not how it works. We're looking at what you're currently doing, and more so with Vantage 4.0 and FICO 10T, it's going to be even more drastic, right? We're looking at your current behavior to assess your risk level. So for him, closing all those longstanding accounts, even though he still had a 750, if he had never come to me, okay, for the borrower readiness program that I have, he would have eventually been a no score. Okay. Debt-free no score sounds okay. No savings. Now he can't qualify for things that he might need, right? And because he has no savings, very likely that he's going to need to qualify, right? And so now he has a thin file after working with me, because we did add a new file. It's thin. It means it's not time. There's not a lot of time in his credit file. And of course, it's a new file. And he had no plan. Okay. So it took me longer for client A to get ready for the type of mortgage program that he needed for the home that he was trying to buy versus what happened with client B. And I never did a dispute. So I want to show this to you because we have a 750 client and we have a 660 client. One got the loan, one didn't. Which one do you think got the loan? I already gave you the answer. So if you're thinking about it, you didn't listen to me. The one that got the loan was client B, 660 credit score. The one that didn't get the loan, client A, 750 credit score, right? Now, he had no credit history or no negative history. So if I was just a credit repair organization, what would I do with him? I would have nothing that I could possibly do for this guy, but he needed a lot of help. And that's where this borrower readiness positioning comes. And guys, here's the other really cool thing about borrower readiness. It takes time. It's not a quick fix. And that's also the way the credit bureau information is trending with Vantage 4.0 and FICO 10T. It's not going to be a quick snap fix because we're not doing snapshot credit anymore, right? We're looking at trended. And so we're going to be able to help people better. We're going to actually be partners with them. We're going to be their trusted advisors for the long run, not for 30 days. So you guys out there going, I can help you in 30 days. Oh, it's credit sweep, 7 days. Forgive me, 7 days. 7 days, 30 days, 60 days, 90 days. No, it's not going to work. So figure out a different message, right? Didn't work anyway, honestly. Maybe you improve their credit score in 7 days, 30 days, 60 days, 90 days, but doesn't necessarily mean that they got on that credit score. And so that's the message that I'm trying to drive into, right? Is that people want what they think the credit score is going to get them. So as a borrower readiness coach, your job is to figure out what do they want and how can they get it. It's pretty easy, actually. Again, Level Up Score is built for this, right? We build it for this exact reason. So I'm going to ask you and beg you, stop selling numbers. Start selling outcomes. Instead of saying, let's get your score to a 700, say, hey, let's create a plan that gets you into the home. That actually sounds a lot better, guys. Even sounds better. Forget that it is better. It sounds better. Let's create a plan. Let's create a plan. I like that in so many ways. When I say, let's get your score to 700, I think instantly they think I'm going to do all the work to get them to a 700 because I have the solution for the 700. But when I say, let's create a plan, I think it already states, hey, we're doing this together. I'm the professional who's going to create this plan that's going to work for you based on your goal, right? And guess what, guys? Level Up Score does it for you. You know that, those of you who use it. Those of you who don't know, join me on the Borrower Readiness class that I'm going to do on Wednesday at 5 p.m. Eastern Time. I'll give you some more information about that at the end. But let's change what we're saying. Let's stop saying, well, let's raise your credit score. I got this person's score up 100 points. How about let's say, hey, I got this person's score up 100 points through doing my Borrower Readiness program, and they were able to qualify for a home loan. Ooh, that sounds good. They got something for it. They got something for it. I think that's really important. All right, let's move on. Oh, I like this. The marathon analogy. So those of you who may or may not know, I used to run marathons. And then after running marathons, I became a marathon trainer. So you can come to me and I would help you learn how to run. Now, let's think about this for a second. We're going to put this in perspective of credit. And let's say you came to me, I'm a marathon trainer, and you came to me and I said, hey, I'm going to get you the best shoes you can possibly get to run this marathon. And I help this person get the best shoes. Can they run the marathon? I help them get the best shoes. Can they run the marathon? The reason I bring that up is because if we think about us as credit professionals and we say, hey, I'm going to get your score to 750, can they buy a house? Can they refinance? Can they buy the car? What does 750 do? It's like getting the really good shoes, right? Yes, that's a tool. As a marathon runner, it's important to have the right shoes. It is. It's important, girls, to have the right bra. It's important to have the right everything because you're running for a long time. It's important to have the glide stick so you don't get burned up, right? Rub burn and stuff like that. So those are all tools that are going to help the marathon runner be better. But in that, it's not going to help the marathon runner run, right? So there's additional things. We have to look at nutrition. We have to look at training. Again, all of these are tools. We have different sets of tools. Like remember I said, if someone wants to buy a house, one tool is the credit score. And then above that, it would be maybe there's disputes that may be done. So those are tools. So these tools up here are less important than this tool versus this, right? And so same thing with a marathon, right? We have marathon training. We have the training, the nutrition, all in kind of this tier. And above that, the shoes, the glide stick, the gels. Does that make sense? Does that resonate with you guys? So if we think about that again with the marathon analogy, I can't just tell the person who comes to me who says, hey, I want to run a marathon. And I say, great, I'm going to get you the perfect shoes. I would not get any more business. Let me tell you that much. They'd run their first marathon with the perfect shoes and not be successful and probably wouldn't make it through the marathon, right? So if we're selling people on getting the highest credit score, the perfect shoes, AKA the perfect shoes, and then they go to the lender and can't get qualified, right? Same thing. That's what we're doing. That's essentially what we're doing, right? Or going to a personal trainer and saying, hey, I want to lose 10 pounds. And the personal trainer goes, great, do these workouts. And that's it. It's not it, right? So again, thinking about that, you know, are we giving them what they asked for? I guess that's the moral of the story. Are we giving them what they asked for thought, right? So here's my theory. We have the missing professional. So we have this home buying journey. Now let's think about this for a second. So the home buying journey, we have real estate agents help people buy homes. We got the loan officer helping finance the home. We got the insurance professionals who protect the home. And we're missing something. We're missing something vitally important in this home buying journey. So let's go back to that again. We have the real estate agent, check, good, important. We have the loan officer, check, good, important. We have the insurance professional, check, good, important. What are we missing here? We're missing the person who educates. We're missing the person who coaches. We're missing the person who creates strategy. We're missing the person who closes the gap between them being able to get the loan or not. We're missing that person. Now, granted, the credit industry as it is today tried to bridge the gap with credit repair, and it worked, but it doesn't work now. And that's the problem with a lot of industries. We think of like Blockbuster Video, right? They didn't change with the time, so they are no longer relevant today, right? They're gone, so they're really not relevant. But their whole business model, not relevant today. We didn't get the message in 2008. Sorry, guys, we didn't get the message. I don't know why we didn't get the message, but we didn't get the message in 2008. The industry changed in 2008, period. It didn't go back. Not only did it change in 2008, but it continued to change. So the gap from where we were at before 2008 to where we are in 2026 is huge, and we never filled it. We stayed credit repair organizations. We didn't get the message. We don't need credit repair professionals. Credit repair professionals, if you're listening to this, we don't need you. We actually don't need you. You're irrelevant in today's market. And in 2027, even more so, you will be, and in my opinion, completely irrelevant. So why are you a credit repair professional? My challenge to you is to bridge the gap, fill in the missing role, which is a borrower readiness partner. And we've made it easy for you with Level Up Score. We have created the action plans for your clients. We have helped you become a borrower readiness partner. So if your client's score magically increased by 80 points tonight, would they automatically qualify for the loan they want tomorrow? Stop asking, how can you improve their credit score, guys? Stop asking that and start asking, how can I prepare this person for the financial future they want? Keyword they want. Find your niche, get good at it, and help that person with what they want, what they really want. It's not the 750 score. Because if they could get what they want at 600, they would go get what they want with 600. I showed you 750 guy, 660 guy, 660 got it, 750 didn't. So it's not the score. And I can tell you story after story after story of clients with high credit scores who came to me because they couldn't get what they wanted. It's not the score. I don't care about the score. So if this resonates with you and you have not seen Level Up Score, if you have not been introduced to the Borrower Readiness strategy, the Borrower Readiness Partnership, I would love for you to be on my call on Wednesday. It's at 5 p.m. Eastern Time. And if you are wanting to be certified as a Borrower Readiness Partner, that program is getting ready to launch. And this is being recognized by the mortgage industry. Okay, so this is not just me creating a certification. I have it as a recognized certification with the mortgage industry. So if you are interested, I want you to comment, "Get me in," and we'll put you on that list when that rolls out. So it is being refined right now. Again, it is not just me creating a certification, guys. This is being recognized in the lending world. So if you want to get in on this, comment, "Get me in," and let's see how many people we can turn from credit repair professionals to true borrower readiness partners. And more importantly, let's see how many people we can get to the promised land. And if you guys don't remember what the promised land is, remember when a client comes to you and they have a goal of buying a home, buying a car, PG business funding, whatever that might be, getting them to that goal, that's getting them to the promised land. That's our job. And if we could do it, we get to keep it. Thank you guys for being here at Tuesday Top Tip. I look forward to seeing you on Wednesday at 5 p.m. Eastern Time for our borrower readiness session. Have a great day.